Welcome to the Commercial Real Estate Show, your source for market intelligence, forecasts, and strategies. Thanks for being with us on one of the 47 radio stations around the country. Maybe you're watching us on YouTube or maybe the show website, commercialrealestateshow.com. Thanks for being with us. I'm Michael Bull. Today we have a cool subject for you. We're going to talk about industrial real estate. We're going to talk about logistics. We're going to cover the performance of the industrial market and what to expect moving forward. We'll also talk about various cap rates and what to expect in the investment market moving forward. We're going to talk to a logistics expert and get some help on logistics, right? We all need that last mile. We're also going to talk about we're going to talk to a big developer of industrial properties and get his view from the street level of what he's seeing in the marketplace. Well, please welcome my expert analyst here. And we have Renee Sirk. He's Director of Research with the CoStar Group. He's joined us here in Studio One today. Renee, thanks for being with us.
Yeah, happy to be in the studio.
Yes, all the way from Chicago, right?
That's right.
Right, come down here to Atlanta, and we appreciate it. So how has the industrial market performed, so far in 2016, and how does that kind of compare to what you've seen in 15? Any changes?
Well, every quarter I say it is harder to imagine a healthier market. And the next quarter I'm proving wrong because the market just gets better and healthier. So I think that theme continued into the first quarter, into 2016. We always see a slowdown. Fourth quarter always tends to be the strongest quarter. And the first quarter always tends to be the weakest quarter. So we did see a slowdown, but logistics coming in about 35 million square feet absorbed. This is on a national level. It's the strongest first quarter essentially we've seen since the beginning of the recovery. So it is not slowing down.
Wow. So what's that doing to rental rates?
Well, when you have vacancies at 7.6%, rents are growing. Last year we saw rents growing 5.5%. Looks like if you take the annualized number for the first quarter, we are there or higher. Year over year, right now we are about 6% for logistics, and annualized first quarter is about 5.8. So very strong.
Right. So you expect to see rental rates continue to increase then in the industrial world?
Well, we absolutely do. We forecast 206 metros, and on a national level, we do expect rent growth to remain essentially this year and next. Although we do expect it to moderate just a little bit, because there is construction now, and especially on the speculative side, and tenants are starting to have a little bit more options of this new space coming on versus what they had about a year ago.
And is most of this new space the mega buildings, or are you seeing some of the smaller buildings as well now?
We absolutely started with the mega buildings this cycle, and every quarter I expect it to trickle down, and it is a little bit, but still vast majority of it is 500,000 square feet and up, 36-foot clear ceilings, big buildings. There is a need for the mid-size multi-tenant building pretty much in every metro, even a metro like Dallas, which saw 5 speculative million square foot buildings going up at the same time. The little stuff is still behind the curve a bit.
So that's where some opportunities are then maybe for investors and developers and just kind of that mid-size?
Without a doubt. We are essentially an advisory arm for CoStar. We work with a lot of institutional investors, and that has been our recommendation for at least 12 months now. Initially, we recommend buying that stuff because it was trading significantly below replacement cost. Today, we are more closely aligned with this is the product you should be building.
And are there certain markets that you're seeing more growth or more opportunity in?
Well, the big Dallas, Chicago, Inland Empire, Atlanta, Northern New Jersey, they are still the big markets. On the smaller side, we definitely see more opportunity in the fast growth markets. Atlanta had a slow start to the recovery, but now it has caught up quite significantly. This last mile that you mentioned is definitely driving demand more closer to the city, and clearly the bigger the population, the better the opportunity. I think the only market where we're being cautious right now is Houston because of the energy prices.
We're talking with Renee Sirk with the CoStar Group about industrial real estate. And so in this last mile, what type of buildings are you seeing that are leasing up for this use for last mile? Is it smaller buildings, mid-sized buildings, or is it buildings really built for industrial or some being converted?
Well, it's definitely smaller, right? So you have the million square foot super regional distribution fulfillment center. And then getting closer to the city, we are talking maybe a 200,000 square foot requirement. And while the big buildings are quite specialized, although most developers try to build them so they can convert them when that tenant leaves, next generation, the infill buildings are, standard building, 32-foot clear probably works, nothing fancy. Now, when you go to cities like San Francisco and New York, really infill, some interesting scenarios are being contemplated. Even the first multi-story building, industrial building, is being contemplated by Prologis in San Francisco and in Seattle. So that would be a new one. That would be a first one for this country.
Okay. So do you expect new deliveries to increase in 2016 and moving forward, or to kind of stabilize, or?
It's going to continue to rise. That's one of the reasons why we expect the rent to start moderating. Still grow, but not at the same rate. We do expect vacancies to start rising this quarter. They were flat at 7.6% in the first versus fourth quarter. We are tracking about 150 million square feet under construction right now, which is this is just logistics. So that's a meaningful number. Last year it was about 120. Year before it was 80. Before that it was about 40 under construction. So it's definitely coming up.
What about flex buildings? It seems like some of those buildings have not done as well in some markets. What do you guys see there?
Flex continues to be the building of last resort, I think, for tenants, and it's also true for owners. There's not a lot of interest in those buildings because there are specialized investors who focus on this. Yeah. But if you think about a lot of the demand for flex buildings sometimes comes from office tenants when that market gets very saturated, and that's definitely not the case. Suburban office is not doing very well, so flex is probably the least well performing segment of industrial.
Yeah, and that's interesting, especially when you see some of these smaller tenants starting to come back, like in home building type of tenants that are related to that industry. So what tenants do you think are going to create the most demand moving forward for logistics, industrial type buildings?
Well, it's still going to be, on the light industrial, it's still going to be the home building related industries, and actually manufacturing is a decent driver. And now the dollar being strong, that's not helping. In fact, that has been hurting the manufacturing sector, so that's a negative. I think if you think about the last decade, it was about the containerized imports. This decade, it will continue to be about e-commerce and infill, probably more than anything else. At 2% GDP growth, it's hard to see anything outperform unless there's a structural shift, which is exactly what we are seeing in e-commerce.
Renee, have you seen anything in the numbers that maybe surprised you? It seems like, with the Panama Canal and some of the deepening of those ports and expansion of those ports, it seems like we keep expecting things to change a little bit in performance in some of these markets and property types. Anything stand out to you?
Well, the Panama Canal is really not operational yet. It's about to happen, so we'll see. We've done a lot of research on it. Our view's been it's not going to be as impactful on the East Coast as a lot of people would expect. I think the primary beneficiary are markets like Pennsylvania, the Lehigh Valley, York, Reading, Harrisburg, that corridor. Stealing a little bit of demand from Jersey, central and northern New Jersey. That has been probably the greatest beneficiary of this. Everything else, it's going to be the standard market. It's going to be the Atlanta benefiting from Charleston and Savannah. Obviously, Houston and Dallas benefiting from Houston. And a lot of that stuff from New York is going to go to the Lehigh Valley.
Yeah. Well, at least I'll be able to get my boat through there after they widen it for me.
Yes, that's for sure.
So opportunities then for industrial investors or developers. So not flex. No, you don't. Not flex.
Not this cycle.
But maybe some of the mid-size buildings.
I think the best opportunity right now is to build mid-size. You can do it almost in any market. Obviously, you have to know what you're doing and pick the right sub-markets, all that stuff. That's probably the best opportunity. If you really think about it, the recession is coming, right? We are thinking maybe 2 years from now. No, not today. Not by the time I leave the studio, but probably a couple of years. So by then, it's going to be one of the longest expansions we've had on record. And so locking in tenants today for 5 years, you'll weather that recession quite okay.
Yeah. Well, I guess you'd hope you'd lock them in longer than that, I guess, if it's a big industrial lease, right?
For sure. That would be talking 10, 12 years, right?
Yeah.
Even more.
Yeah, well, it's interesting. And it'd be interesting, too, to talk about the investment market and, if the recession, the bad weather's coming in 2 years, what should we do there? So we're going to take a break. Renee's going to stay with us. We're going to talk about the investment market. Should you be buying? Should you be selling? What do you expect with cap rates? How interest rates might impact values in the industrial market? Stay with us. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you by Valuate. Easily share what-if analysis online with colleagues. Visit getvaluate.com. Welcome back to the Commercial Real Estate Show. I'm Michael Bull, and we're having fun here in Studio One with Renee Surk. He's with the CoStar Group. And Renee, we're talking about industrial properties. We're talking about, it's remarkable how well this market is really done. And you said it surprised you, right? So what's that doing to the investment sales market, the capital markets? Are investors really still flocking to this sector?
2015, without a doubt, it was an incredible year, record year. We saw new institutional capital flowing in. I get calls from non-traditional institutions all the time, non-traditional industrial investors all the time. They want to get in. Absolutely the case this last year. This year, a big slowdown. Our year-over-year stats, they will improve a little bit because the collection time takes, it's lagging a little bit. But we are down like 30% on the investment volume. There was a little bit of a scare at the beginning of this year. I remember I was speaking at a conference when the stock market was down 550 points, and you thought you were at a funeral. So there was definitely a sort of an emotional slowdown at the beginning of this year. But also, if you really think about it, there's not that much stuff to buy. So it's not as much of a function of capital not wanting to get into industrial, but last year we had Cobalt, we had IIT, we had KTR, we had Blackstone right there. It's like $20 billion, right? So that's gone, and then it's not going to retrade again. And there aren't that many other platforms that somebody can go and buy. So we've absolutely expected the investment volume to be significantly lower this year. Not due to lack of trying, but due to lack of sellers.
Right. So it's we don't have to worry about it. It's just what happened because there's not enough product out there to hit those numbers again. What about cap rates? What do you see there?
Well, cap rates, there is a relationship between cap rates and interest rates. It's not as strong as a lot of people would expect. We estimate to be about 67 basis points. So if interest rates go up by about percentage point, cap rates follow by about 67 bips. Interest rates are not really going up. So cap rates are staying flat. On the best properties, it is difficult to imagine for them going much lower. But there is still a very wide spread between the A and the B stuff. There is more room for the B stuff to compress, especially if there's not enough A product on the market. So that's something to watch.
Wow, so B could compress even more.
B could.
That's interesting. I thought you might be saying that B, and if you want to look at the lower classes, that they could be more impacted by rising interest rates because of maybe lack of demand. I mean, we know we have that big demand for A product, seems like all the time, increasing from all over the world, but maybe a little less on the B and C type of stuff. But
well, C, I wouldn't go all the way down there. But on the B side, the question is, does the capital unable to find the A stuff, is he going to be willing to buy B, or is he going to be willing to take the 4-handle cap rate to a 3-handle cap rate, right? Yeah. And I think on the best stuff, we are probably as low as we, at least at minimum, should be. And so there may be some B opportunities out there.
Right. And industrial investors, from institutional size investors from other parts of the world buying in the U.S., I guess they're not as concerned like they are when they're buying office, that it's in Miami or Boston or New York. They're really looking at industrial markets that are hot, that are like all the ones that you've talked about that may be all over the U.S.
I think that's historically been the problem for foreign capital. In the shop, we always joke that foreign capital doesn't take connecting flights. Mm-hmm. So where it lands in the U.S., whether it's New York, whether it's L.A., that's where they buy, Boston, San Francisco, and that's it. They don't buy the middle of the country.
Yeah.
Even Chicago has fallen off the radar for a lot of, on the office side, for the institutional capital. Industrial, you got to go to these random places like Pennsylvania and Memphis, they never heard of. And so there was always a reluctance. Last year, we absolutely saw the exact opposite, right? All those big transactions I mentioned, those portfolio plays, they were all essentially bought by either 100% or partially by foreign capital, and they were all over the country. So if you want to do industrial or you're international, you got to get the map out because you're not going to be buying in 4 or 5 cities.
Right. And what are some sample cap rates that you're seeing today?
Well, I mean, the best stuff, we've seen 4 handles in California. And, it's not unusual to see a 5 cap in, a market like central Pennsylvania. Dallas has gone really, really pricey on the cap rate side. And I think that is the biggest difference right now, that the best stuff is at extremely low cap rates. And to date, the rent growth has justified it. But the long-term rent growth in a market like Dallas is much less than in a market like LA or Inland Empire. And so I think there is a little bit of mispricing going on right now, and there may be a little bit of a pain during the recession as a result of it.
Well, so if you're advising an investor, a client that has a lot of, say, A properties, institutional or otherwise, is it time to sell? You said bad weather could be coming in 2 years.
Yeah, no, without a doubt, this is the peak of the market,
Yeah.
right? We can be at the peak for a year or so, but this is the peak. So if you have the ability to not be a real estate investor, this is not necessarily a bad time, like Zell selling Equity Office, last cycle. But if you have to be in real estate, that's your job, right?
Yeah.
Institutional capital is giving you the money to invest. Then if you sell the best stuff today, probably you'll have to buy it back at a higher price over the next year.
Yeah.
So I would say this is the time to buy the best quality buildings because they usually don't trade during the recession. But if you want to be buying a light industrial product, if you want to be buying a lesser quality product, that does go on sale during a recession.
Right. And these low cap rates you're talking about in the 4s and 5s, I mean, these are nicer, newer buildings with very long-term leases traditionally, right?
Absolutely. So that would be the new e-commerce buildings, whether it's Amazon, obviously good credit, Home Depot, those kinds of tenants. If you buy that building, the difference between industrial and office that your cap rate is also your cash flow yield.
Yeah.
You're not going to be putting any money into that building for the next year. It's like the rotisserie grills. You set it and forget it.
Right.
And so you buy it, and then 10 years later, remember you own a building.
Right.
So you don't really care about the next recession. That is by far the best recession protection you can get.
Yeah. That's funny you said that because I have woken up from a dream where I was dreaming that I own properties and I have forgotten I owned them. Now, I don't have that many properties, listeners, so I'm not boasting, but I have had that dream where, did I ignore a building that I owned out there somewhere? So, Renee, where are the opportunities for investors right now? Is there a certain size, property type, area that you might recommend?
I think the best stuff is pretty much priced to perfection, and it's priced beyond most people's cost of capital. Right? We talked about the foreign capital. They look at things a little bit differently. Yeah. So I think really the opportunity now is there's still some opportunity in the middle segment. In the previous segment we talked about building it. The spread to replacement cost is not as wide. You should have been buying it 2 years ago like crazy. There's still some opportunity because the price of construction has gone up, but it's getting tougher and tougher. There's nothing easy anymore. It's actually some work now needs to be done.
Yeah, so you may have to buy maybe some markets that hold some promise, maybe some leases, maybe some things that have some turnover, maybe a little more risk to get the yield.
I still would be very comfortable buying vacancy.
Okay.
Even though I'm talking about recession coming eventually, is 2 years. With the strength of the demand and the vacant square feet being so low at the modern space, there's still opportunity to buy things that need a little bit of love.
Okay. Well, you'll probably be quoted on some brokers' packages then. Vacancy is opportunity, what Renee says. Renee,
Without
thanks
a
for
doubt.
joining us.
Thank you.
And well, stay tuned. We're going to have more on the industrial market, including some logistics talk and some tips there. And we're going to talk to a developer and get his view of the market. This is the Commercial Real Estate Show. I'm Michael Bull. Stay with us.